to Nirmal, ladies and gentlemen. I'm Hiral Datia. We have with us Mr. Andrew Holland, CEO at Avendus Capital Public Markets Alternate Strategies LLP, joining in. Welcome to the show, Andrew, and a pleasure to speak to you and get insights from you. Andrew, my first question coming to you is what's happening across global markets. Inflation has been a concern. Everyone's on the rate hike spree, and everyone wants to pull out liquidity from the system. How are you viewing the global markets?
Great question, and thank you. It's always a pleasure to be here. Thank you for inviting me again. This is what we're all grappling with is what next. Now, I have three parts to this kind of view. One is obviously the shorter term, which is to answer your question, and then trying to look through this to what next, because I think that's going to be the key for markets. So in the short term, we still have to see, obviously, the Fed and the ECB increase interest rates, and for the Federal Reserve to reduce their balance sheet. So my concern over this is twofold. One is, are there any unintended consequences of this tightening? Because we've been living this liquidity gush for so many years now. So what's been hidden under the carpet? And I think if you look at a trailer of maybe what might happen, you can just look back to China in 2021. They tightened, and the unintended consequences obviously in the property market, and that's what's really happened there. So could there be the similar situation globally? It's difficult to say where that might come from, but it could come from the kind of credit areas. That could be the exposure. I think we've seen some damage already in the crypto world, right, because of this liquidity moving away, and maybe Europe. Again, if Mario Draghi continues to want to resign, that could have bond yields rising in Italy, and obviously putting more pressure on Europe as a whole. So unintended consequences, one, and two, because of this, as you pointed out, people are now thinking about recession. So have earnings forecasts actually been revised down enough? I don't think so. I think we've got more revisions to come from analysts globally in terms of revising earnings down. So that's a near term in the next few months. But we think by October, the Fed will actually stop or pause in terms of raising rates. And we think that's because the aggregate demand would be falling so quickly, not just in the US, but globally, and particularly in Europe, where disposable income now is going on three things: energy, food, and higher mortgage rates. So that disposable income will start to kind of come down. So I think by the end of the year, we'll actually be thinking about deflation rather than inflation. And that's the key for then markets to kind of think about interest rates remaining lower for longer, and the risk on trade coming back, and emerging markets garnering some of that risk on money, and India being one of the favored markets because of our GDP growth.
Right. So overall, what's the impact we could see on an emerging market like India, Andrew? Because, everyone's talking of there could be a recession in the US, there could be a recession in the Europe, but that's something, as you're saying, it could be a short-term phenomenon. However, it could be good for a country like India. How would you opine on it?
No, I think that's what I'm trying to say is that because of the problems in the developed world, once interest rates stop stop rising, and the Fed goes on pause, then people will start looking about of where they can find growth, and that risk on trade comes back, and emerging markets will be one area which obviously investors will look towards, and India will stand out because of its GDP growth. So I think we will get foreign portfolio flows coming back to India towards the back end of the year into 2023. So that's why I think India is going to be a benefit of this. But in the very short term, because of those potential unintended consequences, markets in globally could fall another 10% from here, we might the Nifty might kind of head back towards that 15,000. But I think in 6 months' time, whether it's today's levels or 15,000, will be higher than this if the scenario just kind of opine plays out.
Right. So with all of this said and done, now, if you have to see a market like India, what's the sense that you're picking up? Because we've seen a lot of corrections that have come in, recoveries that have come in. So clearly, it's pretty hilly right now from the equity market perspective as well. So what are you making of it?
So, we've been saying for some time that the first half of the year, so it's a year of two halves. The first half of the year would be all about volatility, and that's what you're still seeing. Because the market's grappling with some good news occasionally and then the bad news coming in. Now, what I think that in terms of going forward, we're going to have this extra volatility in the next month or so because of the interest rate hikes that we're going to see from global central banks. But thereafter, if that scenario plays out, then we have a very good long runway over the next few years for markets to move higher, in my view. So that's what I think investors have to think about. So, do you need to kind of rush into the market right now? The answer is you can sit on a bit of cash, right? I mean, cash is also an asset class in more volatile times. You might miss the first 3-5%, but in a longer term trend, you don't have to take that kind of volatility. And I think that's what has helped us in the past 6 months to kind of weave our way through some of this volatility.
So is it right to say that for the next 1 month or so, you would advise to sit on cash?
If markets fall, I'd look to deploy it more. I think we've been sitting on cash. So I think the first 6 months of the year was to sell in any kind of, rally rather than the buy on dips type of thing. I think now is, if the market goes, towards that 15,000, it's the time to deploying, into the markets, would be my view.
Right. And overall, if you see in terms of what's happening with crude, the kind of volatility that we're seeing, corrections have started to come in. Officially, we are in the bear market, if you see in terms of crude. But do you think this is a number that's going to be sustainable, or do you think we could see further corrections? And what's that sustainable rate that we should be working with, taking into consideration the negotiations that have been going on between US and Saudi? Plus, you had the recent OPEC meeting as well.
Yeah, you see, I don't think at the margin that the discussions between Biden and Saudi and OPEC are going to really move the needle in terms of supply, and demand is still high, particularly as China kind of comes out of its COVID lockdown. So I think that supply demand is a problem for another 6 months or so. What would change this would be any moves towards peace talks between Ukraine and Russia. Now, is that on the cards? It could well be, and I'll tell you the reasons why. I mean, you've probably seen today that France is having to privatize one of its, utility companies because obviously, they're running out of money. You had recently the same in Germany. So this whole energy problem in Europe is very real, and I think if they can, move towards, Ukraine and Russia kind of forming some kind of peace talks, I think that would be something that would move the oil price down. And do remember that, in Boris Johnson in the UK, who was a former prime minister, he was a big advocate of Ukraine. Will the next prime minister be the same? Maybe not. So that whole move towards, trying to broker a peace, I think will start to happen more in earnest, particularly before winter, because that's when the real pain in Europe will be felt. So that I wouldn't be surprised if you hear more and more talk about that, which should bring the oil price down from where we are today.
Right. And overall, what do you make of the valuation side of it on the Indian markets? Do you think we're still expensive, or do you think we are undervalued right now?
So, part of the problem is this, valuations have come down. But you're also working on the fact that most the consensus earnings is still running around that kind of 13 to 15% growth for the year. I don't think that's possible. I think it's going to be sub 10, because I think the margin pressures that we've been having are not going away in the very short term. For some sectors, it will. So overall, the market is probably at best fairly valued. So you might have a little bit more kind of earnings down. You will have more earnings downgrades to come, and that will obviously push up the relative valuation for India. But I don't think anyone's going to be looking at that going forward. It's going to be, if you get that deflation trade or you get that deflation happening, it's going to be a tailwind for many sectors, right? Where the input costs have been hit very hard. In terms of, say, the autos, for example. If you get your supply chains starting to ease up and come back to normal, plus your input costs coming down, your margins are going to increase. So that's where I think investors, so if you take the next kind of 1 year, you've got to be very focused on which sectors you want to play, which will be the beneficiary of generally lower commodity prices, to the fact that that there'll still be consumers buying their products. And so the deflation trade is really 3 sectors: banking, autos, consumer discretionary. It's as simple as that.
So banking, auto, consumer discretionary is something that you would bet on?
Yes.
Okay. And overall, what would the reason be for those?
Basically, the deflation trade. Because if interest rates are going to be paused in October, then and commodity prices are falling because the global economy is moving towards recession. Europe's definitely in recession already, and the figures don't show it, but it's in recession. I think the US will skirt with recession. So all of this means that your input prices will fall and become more affordable again to people. So that's really where I'm coming from here.
Right. And overall, what would you make, Andrew, of the export-oriented sectors, especially from an IT and a pharmaceutical perspective? Because with the way the dollar has been moving, at least in terms of the revenue side of it, yes, it's a positive. However, these are the economies which might face a recessionary trend as well. So it's a little double whammy situation for export-oriented sectors then.
Yeah, so the 2 sectors you mentioned are this, and we've done quite a lot of work on this, is that see the IT sector has benefited. I mean, let's just take away the more short term. Over the past 1 year, it benefited from the kind of tech boom in the US, right? Everyone was talking about cloud, so the IT companies benefited from that big expansion. Now, if the tech companies themselves are down anywhere between 50 to 70%, because obviously things have turned down very quickly, you're starting to see layoffs, you're starting to see problems, right? Then the sentiment impact towards IT is going to be negative. Now, do you need to buy it now? The answer is you could hide there if you think there's more volatility, but really it's not going to be your growth sector going forward, because it's going to be the deflation trade which you want to play, not the growth trade at the very beginning. So place to hide, yes, but is it going to give you that extra kicker when things turn around? The answer is no. With pharma, we've done a lot of work in terms of, if you take a lot of the input costs, the API costs and so forth, and go back to kind of normalized kind of conditions pre-COVID, it doesn't move the needle in terms of margins. So again, there's a lot of pressure on pricing at the moment, which is not helping some of these pharma companies. So I would say that, I wouldn't be looking to play this export theme because of the rupee. I don't think it's helping. And I would look more to say, what's next after this inflation phase goes away from us? Where do I want to be? The other area I would say domestically is obviously, the kind of, when I say stay at home, I mean the kind of, tourism part of India. I think we all read about what's happening in the UK and traveling there in the airports. I think a lot of people are still spending money in India, enjoying, their travel within India, and all the hotels and restaurants are booked. So I think the domestic kind of spending is going to remain high for at least for the next one and a half years.
Right. And overall, in terms of the overall cycle, the overall trend as well. We've been talking from the macro perspective. How are you seeing growth and inflation pan out in the country?
So, I think the RBI was behind the curve. They tried to quickly get up there. Ours is a different problem than, say, the US. Ours is, see, the US inflation, if you take the components of it, yes, food is a component, but it's mainly housing. So they have to bring aggregate demand down in terms of the housing sector. For us, it's food and energy. Now, if I'm correct about the oil price, maybe kind of heading south if there's any kind of peace talks, and commodity prices falling, that's going to be a benefit to India going forward. Food prices, I think, have always been a problem. It's been one area or the other for India. So, but I don't see it as being anything I'm overly worried about. So I think the RBI might have to do one more rate hike, and then I think they can go on pause along with the Federal Reserve going forward. But they can't be too accommodative is what I don't think they can afford to do that. Otherwise, it would only be felt in the rupee.
Right. All right, Andrew. Thank you so much for sharing your views. And it's a great pleasure always to speak to you, get insights from you. And always it's a candid view and opinion that you share, which really helps investors across as well. Thank you so much. Stay safe and speak to you soon again.
Yes, thank you very much for the opportunity.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.